All right, welcome to The Explainer. Today, we are diving deep into the story behind the actual money in your wallet. It's a wild story, actually, that connects a solid bar of gold, a barrel of crude oil, and a single, critical decision that completely rewrote the rules of the global economy.
You just heard from financial journalist Ron Insana, and he's talking about the early 1970s. For him, it was a time when the calm, predictable economic world he grew up in just shattered. A period of stability suddenly became a decade of pure financial chaos.
So, what on earth happened?
Well, to really get what went wrong, you first have to understand the system that was in place before it all fell apart. A system that was supposed to last forever.
Okay, so Section 1, a world built on gold. Picture this, World War II is over, the world is in pieces, and the leaders of the Allied nations get together to figure out how to rebuild. They decided to build the new global economy on a foundation of trust and predictability, all anchored by one thing, gold.
And the rule book they came up with was called the Bretton Woods System. It was designed back in 1944, and its main goal? To stop the kind of economic chaos that leads to, world wars. This thing was supposed to be a permanent fix.
And the system they built was honestly pretty genius in its simplicity. Here's how it worked. The United States, which had the strongest economy by far, made a huge promise. Its dollar would be directly backed by gold. Then every other major currency would fix its value to the dollar. It was like a pyramid of stability with solid gold at the very bottom. In this right here, $35. That was the magic number. For almost 30 years, the entire world ran on this one simple promise. If you had 35 US dollars, you could walk up to the US Treasury and trade it for 1 ounce of gold. But, by the late 60s, that promise, well, it was starting to look pretty shaky. Okay, on to Section 2, the day the dollar broke. The whole system was creaking and groaning under the pressure of huge US spending, and then, with a single announcement on TV, the entire house of cards came crashing down. So, how did we get here? Well, the problem was just basic math. The US was spending way more dollars overseas, rebuilding Europe, fighting the Vietnam War, than it actually had gold in its vaults. And countries like France, they weren't dumb. They saw what was happening, and they started calling America's bluff, showing up with piles of dollars and demanding their gold back. And this all leads to August 15, 1971. In a move that absolutely floored the entire world, President Nixon went on television and announced he was closing the gold window. That was it. The U.S. was officially breaking the link between the dollar and gold. The promise was broken. The anchor that held the world economy steady for nearly 3 decades was gone.
And the fallout? Whoa, it was immediate and it was huge. Without gold to back it up, the U.S. dollar's value just tanked on the world stage. We entered a totally new era of floating exchange rates, where prices were set by the market, not a gold peg. And that created a ton of uncertainty.
All right, Section 3, oil becomes a weapon. Now, this massive drop in the dollar's value, it created a huge headache for a very specific group of countries, the ones that sell oil. And their response would create shockwaves felt at every gas station in the world. So let me ask you this. What would you do if you got paid in a currency that was worth less and less every single day? Well, that was the exact problem OPEC, the big group of oil exporting countries, was facing. They sold their oil in dollars, and now those dollars were shrinking, and they were not going to just sit there and take it.
400%. Let that sink in for a second. To make up for the weak dollar and using the 1973 oil embargo as their leverage, OPEC didn't just raise prices, they quadrupled them, from about $3 a barrel to almost $12. The first global oil shock was here, and everyone felt it. And this right here is where the story gets really wild. In 1975, OPEC made a deal. From now on, if you wanted to buy their oil, and everyone did, you had to pay in one currency and one currency only, US dollars. And just like that, the petrodollar system was born. The dollar wasn't backed by gold anymore. It was backed by something the modern world needed just as much: black gold, oil. So let's move on to Section 4, the dollar's shock therapy. Okay, so you've got a dollar with no anchor, and you've got oil prices going through the roof. What do you get? A toxic mix that kicked off a decade of just crippling, runaway inflation. The U.S. economy was in a nosedive, and it was time for a radical solution. 13%? Can you even imagine your cost of living going up 13% in 1 year? It was completely out of control. So the U.S. brought in a new Federal Reserve chairman, Paul Volcker, and he had a plan, a really aggressive plan that the source material calls shock therapy.
So Volcker did something totally different. He said, forget about trying to set interest rates directly, we're going to control the supply of money itself. And what that meant was he was going to let interest rates go as high as they needed to go to absolutely crush inflation. And boy, did they go high.
20%. Just wow. That was the peak U.S. interest rate in 1981. That was the shock. To stop prices from spiraling out of control, the Fed basically made it incredibly painful and expensive to borrow money. It triggered a nasty recession, but it actually worked.
The effect this had on the dollar was insane. All this money from around the world came flooding into the U.S. to chase those crazy 20% returns. This huge demand created what they called the superdollar, which shot up by 50%. And what about gold, the dollar's old rival? Its price completely cratered. This is where that inverse relationship we see today really got cemented.
Okay, last section. Gold, oil, and your money. So why are we talking about all this history from 50 years ago? Because, and this is the key, the system that was forged in the fire of the 1970s, it's still the system we live in today.
And this slide really boils it all down to the key dynamic you need to understand. Since oil and gold are priced in dollars, they have this inverse relationship with how strong the dollar is. Think about it. If the dollar gets stronger, it takes fewer of them to buy a barrel of oil or an ounce of gold, so their prices tend to go down. And when the dollar gets weaker, you need more of them, so their prices tend to rise. This has been the central game in the markets ever since 1971.
And it is so crucial to remember these huge numbers we're talking about had real-world consequences for real people. That 20% interest rate wasn't just a theory. As Ron Insano remembers, it meant paying over 20% on a loan for a simple Chevy Nova. That's real pain for ordinary folks, and it was all part of that shock therapy to save the dollar.
So the system born out of all that chaos, the petrodollar system, it's given the US dollar this incredible, unmatched power for the last half-century. But, the world keeps changing. Global power is shifting. And it leaves us with this one final, really big question. Is this system going to last forever? Or are we, maybe, living on the edge of another day when all the rules are about to change again?